Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I'll be your host for the next, let's call it 25 minutes here on Options Guide TV. It is the season. We're in earnings season right now. It's officially begins tomorrow morning in my mind, and a lot of people's mind, with JP Morgan's announcement. So I want to do a trade in JP Morgan. We're going to stick with our butterfly. We're going to stick bullish with it. Just in general, the markets are a little toppy, and we're seeing a little bit of a sell-off in the marketplace today. The VIX is still hanging in there, though, right around that 14-15 level. So the VIX is still not showing nervousness, I guess, in the marketplace, but there's obviously a lot going on geopolitically. Things are getting a little hectic out there. And that does have the potential to spook the markets. Markets just have been really strong. A lot of it to do with the AI spend, which has turned out to be almost like a government stimulus, if you will, as far as the markets are concerned. And so I do like the financials. I like what's happening with the yield curve. I like the way financials have done over just in general. But if there is ever a recession, a lot of the banks in there, some people have priced in that possibility, but the banks will get hurt. Usually, money kind of, I should say spend kind of dries up a little bit, and not as many people are out looking to try to get money. But I still like the deal makers. I still think in the big company world, you are seeing more mergers and acquisitions, and you are seeing just deals getting made or getting done and talking about them. So the stocks that I've been bullish on for quite some time now are the deal making stocks, and the two probably biggest ones out there are JPM and Goldman Sachs. The Goldman Sachs is going to be announcing on Thursday before the open. We also have Citigroup, Citibank, if you will, but Citigroup is the name. They're announcing, and they've been a very strong company. They've been a company recently, as far as their chart is concerned, that a real strong move to the upside. They're announcing this week too. I don't mind owning a little bit of C going into that earnings announcement either. So today we're seeing the markets, just like I said. Jay Powell had a video out today. I think there's a little bit of choppiness, and that kind of did a little something to the market. But we're down 6. We're down 1.8%, and I like to take that momentum to the downside, and I want to look at doing an open wing butterfly to the upside. I'm going to center it more around where the underlying market is at right now. So we got the market at 322.99 if we run to the Tradier Pro software, and we're looking at the 320, and we're going to jump over the 322.50. So once again, we're going to kind of stay right at the money. We're going to sell 2 of these, and then we're going to buy 1 of these, and we're paying $3 for it. So we want the market to stay above 320 plus the $3. I like that it's right at $3. Let's call it $3. And in this instance, I'm still in the paper trading account, and they've whatever issue we had last week, they've fixed. I was able to execute our deep in the money option contracts and get those filled. But we're buying the 320, and I say that because I'm gonna actually send this to the floor. I don't think it will get executed. I'm not gonna send it at the asking price of $5. Very strong probability of filling ahead of earnings at the midpoint. $3 is a fine price to pay for this. We want the market to go up. If it goes above 330, we can make $2 on the trade. If it goes above 335, the high strike. If it goes out at 330, the maximum we can make is $10 minus the $3, or $7 on that trade. I'm going to send this to the what if calculator, take a quick peek at it, then we'll come back and we'll actually execute this trade. So right now, and as of right now, this is the profit and loss, and it's mainly because there is so much implied volatility. It should actually be down a little bit lower than that. I don't know if I'm 100% excited about where that's at, considering Oh, we did the June expiration. All right, let's switch this up. All right, that might change things. I like that for $3. Sorry, let's go all the way back to the earning right here. We got till the end of the week. Buy. It might be close, but I really like that $3 price. 1 second. Buy 320. Oh, how is there not? Okay. 315. There we go. Buy, sell 2, and then go 5. Now where are we at? $4. Make $1 on it. I like the $3 trade. Dang it. It was close. All right, here we go. Let's send this one to the what if calculator. That's why the profit and loss graphs now it looks a little bit more conducive. This is a little bit more accurate, and was my hint that I had the wrong expiration. So if we look here, we're looking at the 315. The market right now is at 322.79. We want it to go 325. We did 323. Let's look at this one. Let's keep this one here, and let's go back and look at another one. Let's clear this up. 323.30. The market came down on me. We were at 325. We're down to 322.50. So the market has came off. If we straddle that, we're looking at 327.50. All right, let's see where we're at right here. I don't like to use half strikes on the show, but we're gonna do that. It's a 1 week earnings play. Sell these 2, then go 5 points and buy that one. Missed it again. Okay. It's 22, so we got to do the 27.5. So we're going 5 points down to 317.50. And then we're going to go 5 points up to 327.50. Then we're going to skip to 330, and we're going to buy this one. And we need one more. 360. That's not bad. Okay, 60 cents more. I like this one. Let's do this one. Send to the what if calculator. It's not $3. It's not quite as enticing, but I like this trade better overall. I'd like to pay $3 for it, but obviously I was in the wrong expiration. So here we are. Market is at 317.50. I'm sorry, the strike that we bought is the 317.50. The market's at 322.89. So we're right in the middle of our slope of our payout of our long call spread in our butterfly. Top side of this is 327.50. If we land anywhere above that, we're profitable. Because this is an open wing butterfly, you're looking at 10 points here and 5 points here. 10 minus 5 means this butterfly has to trade for $5 anywhere above our 332.50 strike. And if it does, we paid $360 for it. And if we could fill at the midpoint, I would expect to be able to get a midpoint fill. It's never a guarantee. I always got to throw that in. And don't forget to add any fees that you may have executing the trade. But your max risk would be $360 per 1 by 2 by 1 butterfly. The max upside would be 10 minus that 360. But more importantly, if we blow through the strikes on the upside, we can make 140 on this trade. The market hangs out right where it's at, or if it drifts lower down to this level, there's still a little bit of life left in this trade. So if the market were to open up below the strike on the downside, we could still get out of the trade if we wanted to, and there might be something to salvage. If the market opens down and this thing's trading for $1, you might just want to get out of the trade and not write it. It's really dependent on what JP Morgan says. And it could just be a sell-off because the stock's been strong recently. If we go and look at the charts, we're kind of in an area, we're kind of meandering around, but we've had a real strong move from going back to December 10th all the way up to the upside from, so we went from 300, we went up 30% about to 10%, 30 points to about 360. And now we've came back and off, and we're hanging right around, I'm going to zoom in here, right around the 20-day moving average. You got the 50-day right below it. Strong stock, solid PE, price to book is solid too in JP Morgan. And like I said, a deal making stock. If FedEx is, oh, hey, good morning, Kurt. I see that. And FedEx is up on a down day, right, in general. So I guess it's worth noting if it's up. So that is out there, and that's a good thing, right? Because we do it. I actually have my positions in here because I am in the paper trading portfolio. I'm hoping that everything stays stable inside this platform, and we can hold on to these positions and highlight them from time to time. Here's our JP Morgan stock. We should be down a little bit on that. Our P&L says we're down 195 at this point in time. We're down on NVIDIA. NVIDIA right now is, where is NVIDIA? NVIDIA is 184. Yeah, we're right around 190 when we put that trade on. And here's our 160. We still got 157 days. And this is the Walmart trade that I just executed not that long ago. We did Walmart. And UNH hasn't executed. Okay, let me go look at UNH. Let's grab this trade, make sure that executes. 57.50. Wow. Thing really moved on a 57.55. Yeah, unfortunately, you have to trade on the ask in the paper trading app most of the time to get fills. And there we're at. Right there. Okay, so I'll send the trade and we'll take a peek at it. I'm not going to execute it per se. I mean, if it ends up in the portfolio, that's fine. 360 is where we're at, and now I'm stuck. So that order's been sent to the floor, and now I can't get back to the options grid. Oh, there we go. Now we're moving. I thought we were moving. And it looks like our order executed. Okay, so now we got this. So we got a solid portfolio of stocks. So we'll go back and we'll review this one next week. There's still a couple more positions. We might even add to some of these positions. Oh, I remember in the Walmart trade, we wanted to execute 2 of these, didn't we? Because they were $16 options. This one was a little bit more expensive. So let's go in and add one more to the Walmart position today. Let's just do it from here. Come on. Uh, 105 618 call. Let's buy another one of those. January 105 618 call. Buy. Now we got to pay a little bit more for it. Walmart's up 382 today. That's not happy about that, but we'll go ahead and send that to the floor. Now our portfolio is where we want. We have both of them filled, options grid. Now we have our deep in the money call portfolio. We have a good solid start to it. We got FedEx, we got JP Morgan, NVIDIA, United Healthcare, and Walmart. A nice diverse group of stocks. I like a little bit more in the financials. We'll see how earnings plays out. I wanted to buy JP Morgan ahead of their earnings report. Goldman Sachs is on Thursday, but Goldman Sachs is a much more expensive stock. It doesn't quite fit in our portfolio as well of deep in the money option contracts, but I do like that stock. I think that they uh, a little bit of things have happened as far as the credit card space is concerned between JP Morgan and Goldman Sachs and Apple. That was some headlines in there on the business, and JP Morgan was the benefactor in that news headline. And let's execute. Let's go back to our what if calculator. Here is our trade. We're still sitting right at the middle. Let's send this one to the ticket and see. We're still at 366. All right. Our paper trade, put it in at 360. And I'm going to send this one to the floor. I don't think it will execute. It may execute. I've noticed that in the paper trading platform that it will sometimes give you a little bit of a break, but it doesn't always fill at the midpoint. We're buying the 317.50, selling 2 of the 327.50, and buying the 332.50, paying 360 for this, and that's sent to the floor. Okay, let's see where we're at. So I've already sent this one to the floor. Let's grab this. 360 for the day. Take it and let's just cancel these. All right. So these are the order. So this is the official paper trade for the day. I'm not going to send it to the floor. I don't want to execute it. But here's what we have. We're buying the 317.50, selling 2 of the 327.50, buying 1 of the 332.50. We're going to do this for a net debit of $3.60 to the account. They're announcing earnings tomorrow morning. We are bullish. If the market stays where it's at, we're fine. If the market continues on up and blows through our strikes, we actually can make 140 on this trade. If it's anywhere between we'll just call it 320. That's about where the break even is on the downside. And all the way anywhere on up above that level would be profitable on the trade at this point in time. All right. Now, if we're looking at Goldman Sachs, which is going to be announcing earnings on Thursday before the open, I don't mind looking at Goldman and leaning into a skip strike butterfly, but I want to do it. We'll do that on Wednesday's show, and I'm just going to do it to do something a little bit different. It's a little bit more expensive stock. They're going to announce on a Thursday. You have a Friday expiration, so you got all day Thursday, all day Friday. They announce in the morning before the open. And what I'll look to do is, as an alternative to selling the what would I say? As an alternative to selling a short call spread on the upside. Let's also go look at Goldman Sachs chart. It's fairly similar to JP Morgan. And we have it on the upside. We've had a little bit of a sell-off here recently. 240. Okay, so 970 would be a new all-time high. And I want to look at the trade. I don't want to set it up just now, but I want to take a quick peek at it, see where we're at. We're going to probably go 5 points wide, sell the 1,000. We're on the January 16th expiration, sell the 1,000. And then we'll go and buy 2 of these, and then buy 1 of these. sell to. Midpoint credit of 14 cents. I like it right there. Now, this is a skip strike, and this is something a little bit different. Now, I look at this, the open wing butterfly I've always considered as a alternative to a long call spread. If you were to buy the long call spread in Morgan Stanley, that is a totally fine trade. You just have to pay up a little bit more for it. Why? Because we're selling two options in the butterfly alternative, as opposed to just selling one option contract. So the alternative in the butterfly here, if I go back to it, is you buy one of the 350. Well, that's the wrong one. Here's the last one. You buy one of the 317.50s and you sell one of the 327.50s. That's a long call spread. That's going to be paid a little bit more of a net debit than if we sell two of these and then buy a cheaper option contract. So we get into the position cheaper. We don't have as much upside if the market goes, if it skyrockets on us and blows through the strikes, but we also don't have as much downside risk. So I prefer to do this around earnings because you're going to get a gap opening most likely. It could be to the downside or upside, but you're going to get a strong movement early after the earnings report. So I like to have my risk more contained. If the market does meander and it sticks around where the underlying is at right now, you get paid quickly because the implied volatility comes down and you are short two of the 227.50s. Okay. So, if I'm looking at doing the skip strike butterfly, this to me is the alternative to a short call spread. So if you're looking to get short and you did this trade, I want to get this here, send this to ticket, and I'm looking to get short and I'm doing this trade. Well, here we're doing this for a net credit of 14 cents. If we didn't, we would just be selling the 1,000, buying the 1,005. It would be a 5-point wide spread. So if I go back and I look at the options grid for this and we remove one of these, okay, so remember, let's say this is 14 cents. We could get that done for 14 cents. We're not going to do it. We're not going to do it till Wednesday, okay? And we sell one, buy one of these, get rid of this. Now you're looking at 51 cents. So ideally, I would like it to be about half. If I could get a 51-cent credit from just doing the short spread, I'd like to bring in about a 25-cent credit for doing the skip strike butterfly. Why? Well, you have the alternative here that if you look at the what if calculator, you actually can benefit if the underlying market actually lands where your short strike is. So if you're short the short call spread, you don't get that benefit. If the market opens up and starts going towards you, you have to adjust and you have to trade it right away. If you do the open wing or the skip strike butterfly, where we're literally skipping a strike and betting a short credit spread in it, if we do that, well, we actually already have a hedge built in, but we pay for the hedge, right? So we get less of a credit. The market goes our direction. We can still get out and make a profit. So ultimately, if you put this trade on right now, here's the profit and loss graph as of today, implying that if it opened at 1,000, which would be tough, it'd be a very real strong move in Goldman Sachs. If it opened at 1,000, we would be down on the trade because we are still short these two options, but they got to go away, right? Time decay is happening. Implied volatility is coming out. Expiration is going to be on the 16th, which is this Friday. So they announce on Thursday, you got all day Thursday, all day Friday, and then the options expire. So ultimately, this starts dwarfing into what it looks like at expiration. And that's how it works. So that's the trade I want to look at in Goldman Sachs. We're going to put that one together on Friday. inside the options playbook, if you type in, or if you use a search engine, you type in skip strike butterfly, my book's going to come up. It'll probably be one of the first ones that's not a advertisement that will pop up. And look at skip strike butterfly with calls, and that's a trade we're going to look to set up on Wednesday. And we're going to get long JP Morgan using an open wing butterfly. And then we have our continued positions in on our portfolio of stocks. And we've executed quite a few of them. And we're going to do a review. We're going to still get into some earnings. Maybe we'll look at a review on Friday of our deep in the money positions and talk a little bit in more detail about those option contracts on Friday. That's it for this edition of Options Guy TV. Well, go JP Morgan, and then we will come back on Wednesday, and let's hope the market can, recover a little bit today. That would be nice to be able to end up at the end of the day and for the market to be able to shake off even more news across the world, and we'll see. But with that said, we'll see you Wednesday for the next edition of Options Guy TV, 11 a.m. Eastern Time. Don't forget to click subscribe, ring the bell, and we'll see you on Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.